Hello and welcome in everybody to another episode of the Magnify Wealth Podcast. I'm Cameron Gannon, here with my co-host, Scott Gannon.
Hello everybody.
Reminder to everybody, please go down and like and subscribe on our video. And today what we're going to be talking about is helping you guys understand how policy loans can actually multiply the use of your money. So just to give you a quick breakdown of what policy loans are, understand that the life insurance we deal with using the infinite banking concept has a cash value. That cash value grows every single day, tax free. So you can actually borrow against that cash value, taking a loan from the insurance company while your cash value continues to grow. Of course, that loan has an interest rate because it's not your money, it's the insurance company's money, but it is available to you. So what we're gonna dive into is showing you guys how these can actually kind of offer you a multiple money or a double dip effect, if you will, and allow you to actually invest while your money continues to grow every single day. So why don't I turn it over to my co-host to help you guys understand how policy loans actually do work.
So Cameron did give a bit of a description there, got into a little bit how they work. So the key here is what, and this is many people don't understand, or at least miss in the beginning of this, is when you borrow against the cash value, the key word here is against. You're not borrowing from your cash value, you're borrowing against the cash value. And what that means is you're borrowing the insurance company's money, not yours. So that's how you get the multiple use, or the double dip, if you will, of your money. So for an example, let's say you had $100,000 in there, you can borrow 90% on demand, and now you have $100,000 growing inside your insurance policy, as well as $90,000 doing whatever asset you're buying. Ideally, you're buying assets that produce income, and those are also producing as well. Now, there is an interest rate attached to that loan, but that's really the only part of this loan that makes it similar to any other loan, is there is an interest rate. Interest rates are very reasonable, but there's no credit checks, there's no application, there's no, what is your assets, where are you at, and so forth. Flexible repayment terms are a big one. As an example, if you're borrowing and you have you're paying a couple $1,000s a month or something back toward a policy loan that you borrowed to like flip a house or something, and another opportunity comes along and you want to be able to fund that as well. Well, you can stop the payments altogether. You can actually reborrow what you've already paid back, as well as however much it's grown since then, up to that 90%. So these loans are really, truly constant moving machines that allow you to have the flexibility to do, let's say, start, stop payments, make lump sum payments. And again, the biggest part of this is you order the money. You do not apply for it. All you do is order it, period.
So just to give you guys a sort of idea of the true power that this gives you in the form of leverage, let's have a look at, say, your house. On your house, you could take out a home equity line of credit, and that would allow you to have cash without going, you have cash to go and invest in other assets while your house is still growing in value, hopefully, every single year. I mean, that's not necessarily guaranteed in the form of real estate, but over time, real estate does go up. So that gives you kind of that same dual effect, that you have a growing asset as well as cash in hand that you can go and invest in something else. Big difference between this and a home equity line of credit is, a HELOC is not guaranteed to grow. Banks could come back and say, you know what, it's time to give me my money back if they're in a pinch, or you are. And I mean, also the kind of last difference would be if this isn't your primary residence, the growth on your house is a taxable gain when it comes time to sell, if and when.
So, I mean, the key here, I think where you're trying to get at is we do liken it to almost like a HELOC, although it doesn't. HELOCs require interest payments. You don't have to make interest payments if you don't want. It really depends on your plan. And the The real discussion here is how this leverage allows you, as I briefly explained a couple minutes ago, is you can have, and again, like $100,000 cash in a policy, you got $190,000 working for you if you're obviously doing something productive with it. And that's kind of bridges me right into this whole idea of how does this multiply your wealth? Well, while you are, let's say, again, go back to that same example, you got $90,000, let's say you use it as a down payment on a real estate property, and that is producing cash flow. Okay, that cash flow is funding all your expenses plus, obviously cash flow is after expenses, but it's funding your interest cost as well as the payback on the policy loan. So what does that do? Well, that allows you to keep growing the amount of equity you have available to you. And it goes in two ways. So this kind of magnifies your future access to cash, because as you're paying down the loan, the cash value is still growing constantly every single day, and it never has a down day. And going back to that whole example of the equity line of credit, houses are guaranteed to go up every year. Banks can make decisions on tightening credit and curtailing it. So the idea of it, as Cameron mentioned there about your HELOC actually growing, number one is if it did, you'd have to apply for it again. Number two is they could actually reduce it, and they could pull back money, and they can cancel it. And frankly, they just look at your current financial situation, and if you're overutilized, then they can just say, well, wait a sec, let's have a look at everything that's going on. Like, you're not in control. That's the key point here, is this is your bank and you control it. And that's how, and that gives you the advantage of having that flexibility. Again, ordering, using, paying back, using again. It's a revolving thing. So if you always look at policy loans as ways of, again, this is from an opportunity standpoint, not an emergency, but if you're looking for cash flowing assets, then that will help you fund this. So if you plan it out correctly, essentially what you can do is expand your current cash flow as well as your future cash flow consistently over time, so that you walk into retirement with fully passive income.
So this sounds awesome. So what is the catch, if you will? Well, there is the potential pitfall. You need to manage the loan responsibly to avoid the policy. If the accumulating interest compounds itself past the cash value of the policy, it could cause the policy to quote unquote blow up or lapse. So, the important thing is to have yourself a coach that's done this before that can help you manage the loan to ensure that never becomes an idea. It's something you can use that 90% right away and use it for what you want. There's a reason they only give you the 90% so that this doesn't happen. But if you fully loan out the policy and then let that interest compound, you could get yourself into a sticky situation without a coach to help you properly manage that.
So the finish of that, that's the one thing is this is all fine and great unless you don't manage the ratio of debt to cash value, and that is something that we need a coach for. You need a coach for. It's all about managing it.
And if you've dove into becoming your own banker by our Nelson Nash, you'll know that means something very simple, right? Don't steal a piece.
Don't steal a piece, and what is it? Be an honest banker. That's the word. That's what I'm looking for. Being an honest banker. Yeah. If you had a loan from another bank, well, you're obligated to pay that back. So why would you treat other banks any better than yours?
Exactly.
So let's roll into wrapping this up.
Yeah, let's do it. So just to kind of give you guys a reminder, the true benefit with using policy loan as a invest yourself, whether that's in real estate, whether that's in your business, what you can do is actually completely multiply the use of your money by having cash growing in a guaranteed asset every single day, while now creating more cash to invest in your business or in real estate or in whatever other cash flowing asset you are, interested in pursuing.
Yes, and that cash value, just as a quick reminder, never goes backwards. So you have when you have 100 grand or 200 grand or 500 grand or 20 grand, the next day it's going to be more. There's no chance of it ever being lower than what you're looking at today. So we encourage anyone listening on this to reach out and learn more about how to implement this strategy. It will truly change what you're already doing. And again, it's funny I say change what you're already doing. It will improve whatever you're doing. Again, you don't have to change a thing. We can actually implement this without you changing your lifestyle or what you're already doing.
Thanks for tuning in, everybody, to the Magnify Wealth podcast. I'm Cameron Gannon, and this is Scott Gannon. We'll see you guys next week.
Thanks for tuning in to the Magnify Wealth podcast with Scott Gannon. Remember to subscribe on YouTube or your favorite podcast platform for more insights on the infinite banking concept. Until next time, remember, immediate action is the most efficient way to achieve your goals.